So the question is, will the S&P drop 25%? The thought of that is crazy. Think about it. The S&P is what, around 320 right now, 3,200? That means we're talking about 2,400 or 240 on the SPY. That would put us below the 200-day moving. That would put us way, way bearish. Now, here are the reasons. Let me give you two case scenarios. Technically, we're grossly overbought. We've had the longest bull run since April. The market is stretched out. But here's the thing. Technical price levels, they don't take a long time to correct, and they don't need to stay low for a long time. You could see that rubber band stretch back to the 200-day moving average, 200-day moving average, and which would put the S&P to an oversold territory. It would neutralize all the sectors and put them back in line. They're not in line right now. Right now, consumer discretionary is lagging, technology's leading, utilities is somewhere in between. So there's a lot of things that are not that are causing the S&P internally to be out of whack, so to speak. It needs to settle down. It needs to cool off. It needs to have a pullback. It's way, way, way overdue for a pullback. But again, a pullback can be a 3%, a 5%, an 8% pullback would be a major pullback, okay? So no, you don't need to have a major pullback to make momentum levels neutral once again, or to cause the stock market not to be overbought. So technically, don't see it at all. And also, technically, we have the small caps right now making a huge comeback. That's going to support the large caps. Think about all the market cap you have in the other 2,000 or 3,000 stocks. No, of course, they're not Apple, they're not Amazon, they're not Microsoft, they're not Intel, but there's still some market cap. Some of those companies are worth $2 billion or have a market cap of $2 billion. There is a lot of market cap in the Russell 2000. And for the last, it's not 2 weeks now, it's 3 weeks. They have been outperforming the S&P 500. And that's the first time that's happened since last September 1st of last year. So it's a huge, huge factor. That's technically. Fundamentally, global economy is starting to make a comeback. Inverse yield curve, not as big of a factor. As a matter of fact, every time it's happened, we have another 3 years of a bull run. And with the Fed keeping rates artificially low, I wouldn't really consider the inverse yield curve a major factor. GDP is solid. We're humming along at 2%. Job employment data is at a 50-year low. Trade war resolution, phase 1, we're done. And most importantly, we have a new catalyst on the block, the 5G. We're going to see networks. We're going to be seeing systems. You're going to be seeing end products, consumer products. So you got a whole industry of business to business and business to consumer products that are going to be driven by this catalyst. Companies like Qualcomm are big in it, all right? Microsoft, huge. Intel, huge. There's a lot of money in the 5G network. And remember, bigger bandwidth, more bandwidth, faster processors allow you to do more things on your computers. For example, virtual reality. You can't do it right without 5G. Self-driving cars, you can't do it without 5G. So all of these accoutrements, as I like to call them, all of these factors that come into 5G are going to be, just like when personal computers came out. Think about the market for the chips, the cases, for the video games, all of these things that come with the personal computer, the software products. Think about Microsoft. Bill Gates became the richest guy in the world, and he didn't even make anything to do. He did software, no hardware. So this 5G catalyst, it's not just phones becoming faster. I need you guys to understand that. It changes the whole world. It changes the pipes. The pipes by which the speeds flow becomes wider and bigger by a huge percentage. And that allows us to do things we haven't done before. That changes everything. So there's a lot of factors. So will the S&P 500 go down 25%? I hardly think so. The odds of that happening are less than 0.1%. But I need you to check out my 2020 Wealth Blueprints because it gives you a scenario, it gives you the odds, and it gives you a contingency for each one. Folks, let me be straight with you. The odds of the S&P falling 25% or more over the next year, well, it's just one of the 10 possible scenarios that I cover in my 2020 Wealth Blueprint. My blueprint accounts for all of the what-if scenarios that could happen in 2020 and the best way for you to profit from each one. Fortunately, I've developed several trading systems over the past 2 decades that, when combined, are proven to work in every type of market and economy. And that's why I'm so confident that I can double my entire account in 2020. I've got a trading roadmap and the right strategies to crush the market no matter what happens next. And you're invited to join me. To make sure you succeed, I'm going to give you all of my research and every single trade that I publish. But you've got to join my inner circle today. Your opportunity to join me on this lucrative venture closes in just a few hours. Sign up now. Get all the details by clicking the link below. One thing I'm going to tell you, and one thing I know for sure, I expect volatility to increase dramatically in 2020. It'll be a trader's market. Buy and hold investors will struggle. If you want my help starting now, join my most elite membership level before the door closes at midnight. Don't procrastinate. Do it now. Follow the link below. Talk soon.